and welcome to the quarterly market update for Q2 2024. I'm Hannah Owen and I'm joined today by Dr. Scott Osborne to discuss all things that have happened in markets and the VT Astute funds over the last period. So Scott, it certainly feels like a lot has happened since our last update, which was only 3 months ago. So to give you some examples, there's been a lot of what we'd call market noise. There's been the Middle East concerns seem to spike and then wane. Inflation is coming down, and then it appears that is it going back up again? We think interest rates are going to be cut, and then actually are they going to be higher for longer? Could you just touch on that a little bit?
Yeah, it's definitely been the sort of interesting times as the sort of the curse goes. I think the Middle East is probably the best example of how flighty markets can be, right? Because the Middle East, obviously that flared up, and markets were worried for very good reason. Here's Iran firing hundreds of missiles at Israel. That's a pretty serious risk. But it only took kind of a week of nothing happening for that to fall off of the agenda again. And don't get me wrong, that's a real risk. There's lots of fundamental questions you need to ask about that scenario and things that we need to worry about, but it just shows you how quickly that news cycle moves around. And I mean, the other example that you said there was in inflation interest rates. We entered this year with markets expecting something like 6 cuts from the US Federal Reserve in the US. And I think today we're sort of discounting 1. And that whole move has just been basically predicated on 3 months or 1 quarter of sort of bad data, so inflation coming in slightly higher than expected versus expectations. And I mean, I think we've said in the past we probably entered the year with markets a little bit too optimistic about how things were going to pan out. Maybe now they're a little bit too pessimistic. But again, it just shows you that a very short period of time can have this big impact in the market in real times. And the answer to both is just to sort of step back. The whole point and our job really is to take that long-term perspective and ask the question, okay, does 3 months worth of information drown out all the other data points we've had from the past, the direction of travel, et cetera, et cetera? Does it change our view on the path of interest rates being down? No, not particularly. And again, the Israel and Iran conflict, we did a lot of work as this was kind of flaring up in terms of, okay, oil markets, supply, how much of excess supply is OPEC got if Iran comes out, how likely is the US to intervene, given it's now the world's biggest oil producer. All that work has to be done, and you risk manage the portfolio, different scenarios, etc. But fundamentally, the question is one about how is it going to affect things over the next few years, not the next week or few months. And it reminds me of that very sort of classic chart which some investors will have seen, which is basically if you take 30, 50 years of market events, there's always something to worry about. There's always something on that wall of worry, I think, as you call it, all these different events that occurred. But if you take that longer term perspective, equity markets, risk markets generally push on and go on through. And it's that scenario, it's that sort of dynamic that you seek in to benefit from as an investor. It's our job to navigate these sort of short-term dips and identify the real risks where they are and change the portfolio if we need to. But for us, particularly so far this year, it's been mostly noise. Like we say, we've had to do some work on the specific risk flare-ups, but the market's moved a lot, all the way from being too pessimistic through what we think is a reasonable base case now to being too pessimistic on interest rate cuts. And you've just kind of got to again take that step back, take the long-term perspective, and try and filter out that noise and just focus on the sort of long-term fundamentals.
Brilliant, thanks Scott. Now I know that you've just been speaking about the long term, but I am going to ask you to drill down into a short term point. You touched on interest rates there. Do we still expect interest rates to be cut this year? Obviously interest rate is the question that's on everyone's lips, and I think there is nuance to discuss there. Like I say, our kind of long-term view is basically that interest rates go down, we have a fall in inflation environment, and interest rates will be cut. I think you can position the portfolio as we have trying to do. We're not actually that bothered about when those cuts come, which appears to be what the market is obsessed about. So there is that kind of long-term, short-term conflict. But if we dissect that, what's gone on in the US, obviously we have had this quarter, this one sort of 3 months consecutive inflation data coming in hotter than expected. And it's the kind of US where the worry is for that specifically. And that's then led markets to say, okay, well actually might not be any cuts this year. The next move by the Federal Reserve might have even been to increase rates again.
That was kind of floated out there as an idea in the market, and it's caused a lot of market movements and volatility. We actually heard from Jay Powell, Chairman of the US Federal Reserve, this week, and first thing he kind of stuck a pin in that last idea that the next move in rates might be higher. I don't think there's much appetite for that unless there is a significant re-acceleration in inflation. So that firstly kind of confirms, okay, they believe that interest rates are sufficiently restrictive, i.e., there's enough pain in the economy that it's stopping demand, or it's slowing demand and slowing growth slightly, so they don't need to do more. The other kind of key thing, which is maybe missed a little bit by the broader market, I think, but represents quite a big change in the Fed sort of communication at the last meeting, was that he talked about what's called the Fed's dual mandate over here in the US, which means they have to target 2% inflation, but they also equally have this job over here, which is to facilitate full employment in the economy. So they have this jobs mandate as well. And one thing that he said pretty clearly was that as that inflation number has moved closer to target, because let's not forget, it was like nearly double digits. I think it did hit double digits at one point in the US. That's come all the way down to 3 something now, so much closer to that 2% target. As that sort of half of the mandate has got closer to target, they're obviously worried a little bit less about it. And if all things held equal, they've got this budget for worrying, they've got spending less worry budget over here, which means they can now worry a little bit more about the jobs mandate again, which was secondary previously to this inflation target because it was so wildly off target. So the fact that they're now explicitly saying, actually, we're more worried about this jobs mandate now, even though the labour market looks very strong at the moment in the US still, there are signs of it slowing. And actually job creation has been very strong. That's one of the numbers that in the last 3 months has kind of led markets to worry. But underlying that, there are signs of labour market weakening. Hiring intentions is dipping, so companies saying how they're going to hire in the future. People moving jobs is reducing, so again, it's a good sign of labour market tightness. So there are signs on this side of the mandate that things are weakening, and I think it's very healthy that the Fed has talked about that. And it brings us back to this dynamic, which we think is actually pretty positive, which is actually, okay, if US growth is good, and inflation stays a little bit high, well, the Fed will just keep rates where they are. But that's not a bad scenario. If growth is good, then equities will do well, companies will be earning good money, and actually, if growth starts to come off, well, then this jobs environment will probably start to weaken. If inflation comes down or not, the jobs market will weaken, and that will bring the Fed back into this rate cutting sort of mindset. So even though there's all this noise that we talked about, we still think it's a reasonably positive scenario in the US. I honestly am not that bothered about when the first rate cut occurs. But it's certainly, I think our expectations have been pushed further back in the year. I think our views would now be kind of non-consensus. We still think July is a possibility, or a summer rate cut. We think 3 months appears to be a long time for markets, and data can change between now and then. But at the end of the day, we think the rate cut is coming at some point, and that's all that really matters. It's a slightly different scenario just quickly in Europe and in the UK. In Europe, actually, the inflation mandate looks pretty, the inflation's kind of coming down, it looks okay. Really, they're just waiting for jobs numbers for Q1. They will almost certainly start cutting in June unless there's something that happens in terms of labour markets. And in the UK, again, they might have pushed their expectations back a little bit based on the data. But I don't think the UK and Europe has the same luxury of a strong growing economy that the US has. So they can't really afford to wait as long as the US can if inflation isn't kind of progressing down as required. So what that might mean is that the Bank of England may have to cut rates before the US Federal Reserve, which they probably didn't want to do because it can cause a certain weakening in sterling. But yeah, on the whole, we still see rate cuts across the major central banks this year, maybe a little bit later than we initially anticipated, but actually, like I said, I don't think even in the last video we mentioned we're not really that bothered when the rate cuts come, as long as they come and that's the direction of travel we still expect. So yeah.
Brilliant, thanks Scott. You touched on sterling weakness there. Now, currency is something that we don't often talk about on our client communications, on our updates, on our videos, but it is something that we talk about a lot across the desk. Could you touch a bit more on currency, how it impacts the funds and how it impacts markets? Yeah,
obviously it can be quite important, and it's different for different economies, right? And obviously in the UK we feel it more. As you know, island nation, we're very reliant on imports. We have this degree of what we call import intensity directly into our inflation numbers. So all that basically means is that, you know, we buy our stuff overseas and we spend sterling, pounds, and we're buying stuff in dollars. Although other currencies as well, like we trade a lot with Europe, so the euro matters too. But you know, oil is the classic example. Obviously, oil trades are cleared in dollars, so if you want to go buy your oil for your petrol or whatever, it costs you dollars to do that. If sterling gets weaker against the dollar, well, you still need the same amount of oil probably, but it's going to cost you more to get that amount. And then there's the direct feed through to inflation, more so for us than someone who, for example, like the US, who doesn't have to export any oil into the country because they have it all domestically produced. So that high import intensity and inflation is a risk for the Bank of England, because if the currency gets too weak, particularly against the dollar, but probably also against the euro, it can actually lead to this sort of circular process where inflation goes higher and you're in trouble again in terms of interest rates. The reason that interest rates matter in terms of currency is fairly straightforward, and it's this idea that, okay, again, hypothetical scenario, but let's say the Bank of England cuts rates to 4% and in the US they're still at 5%. Well, as a global investor, I can take my pounds out of my bank account in the UK, change it for dollars, and go earn an extra 1% of interest on US dollars. You know, there's a 5% interest rate over there on a savings account, and there's a 4% interest rate over here. If it was that simple, everyone would do it, and you just get that free additional money. And of course, what happens is the markets, because there's no such thing as free money in markets, correct for that. So as everyone's selling their pounds to buy dollars to go invest in higher interest rates over there, the currency gets weaker. And basically what happens, the currency corrects for that difference in interest rates. And that's why interest rates are so important at the moment, because as we get to this sort of phase of central banks starting to cut and who's going to go first and how high and so on and so forth, it's going to start impacting on currencies. So it's definitely one to watch. The other big area where this is kind of very topical is the Japanese yen. Now, Japan, a lot like the UK, island nation, it imports a lot of stuff, so commodities, energy, goods, and so on and so forth come into the country, so it's exposed to the same kind of inflation that the UK is. It's slightly different to the UK, though. It's also a big exporter of stuff, so you know, machines and manufacturing is a big part of the Japanese economy. So it's a double-edged sword for them, in the sense that a weak yen versus probably the dollar, but other currencies, is good for exporters, good for companies. They can sell, you know, their goods become cheaper overseas, they can sell more, but bad for the Japanese consumer, who just sees prices go higher. Now, Japan would love a bit of inflation, and their central bank has basically done nothing except go from very slightly negative interest rates to very, very slightly positive interest rates, because they've been lacking inflation for decades. They kind of want to see some inflation, but it's getting to that point where it's a bit painful, particularly for the kind of politicians who feel pressure from, you know, real world people when prices are going up because of the weak yen. And actually, we've seen in the last couple of weeks that the dollar got so strong against the yen that they've had to centrally intervene. So they've had to step into the market, sell a big chunk of dollars and buy a load of yen to try and influence that price in order to defend the strength of the yen. And that's a good sign that there is stresses out there in the system, that the strong dollar, because higher rates for longer in the US is pushing the dollar higher, is creating these stress points out there. And whether it be in emerging markets, whether it be Japan or the UK or whatever, it does have knock-on effects. And that means there's a risk out there that we kind of have to monitor and watch for. And like you say, it's behind the scenes. It's something that we discuss a fair bit and think about in the portfolios when we're moving positions around and so forth. So definitely something to kind of keep one eye on as we realise these first round of interest rate cuts, I think. Yeah.
Thanks, Scott. Now we've covered a lot there. Does anything that we've touched upon, does it change our views or our positioning? Or perhaps does it just give us the opportunity for some tweaks around the edges?
Yeah, you can imagine probably from what I said, that overarching theme for us, which is one of reasonable growth, not mega growth, you know, but just okay growth, falling interest rates because of falling inflation. That picture for us is still intact, and that's how the portfolios have been positioned for some time, and it's why we had such a good run from the end of last year and the first part of this year. We still think that sort of picture is intact. We don't see really any significant challenge to that long term. Again, we've had lots of noise so far this year, but over the sort of longer medium term, we're still pretty confident that that's that's the way things will go, and that's how we're positioned. So no massive changes. A few things we have done around sort of the edges. Obviously, that what we talked about there on US rates particularly, they're a bit too optimistic at the beginning of the year and a bit too pessimistic now. We did sell some of our US Treasury positions, so these are US government bonds, in early January because the price had gone up quite a lot because the market was quite optimistic about interest rate cuts. As the markets got pessimistic, those prices have come back down, so we've just rebought those long-dated Treasuries again. Again, just these kind of tactical opportunities that if you've got a slightly longer-term view, you can take because, like I say, we're pretty sure these interest rates come at some point when we don't need them to occur particularly quickly for us, and we can earn a decent yield on it in the interim. So a little tactical trades around the edges, things like that help. And then the only other trade, probably, well, actually it's not trade specifically within the portfolio, but in discussion with our underlying managers, particularly the fixed income side, we've had this, what we say, overweight to credit. So we have a bias to lending money to companies rather than governments. And obviously companies come with default risk and a kind of economic risk around how well is the company doing, is it going to be able to pay those debts off. And we were more positive on the economy than the markets, and so we saw that opportunity in credit, and that's actually worked out pretty well for us. And those bonds have kind of, again, they've got a little bit more expensive than they were. Now, we've not sold any managers or reduced positions, but we know in conversations with our managers that they've reduced risk-taking slightly in that space because of that change. So we're not quite as exposed in that credit space as we were. And again, more than comfortable with that. You know, it's kind of, the market's come around to our view in that sense that the economy is going to be a little bit better than we thought. So it makes sense to reduce the risk-taking there, particularly given some of those positions have performed very well for us. So yeah, no massive changes. Again, that long-term view hasn't changed. Within the noise, we've seen a few tactical opportunities to do things, and we've taken those where we can. But generally, we're pretty happy with positioning and our view for the year ahead.
Brilliant. Thanks for that, Scott. And thank you for joining us. That's all we've got time for today for this update. If you've got any questions about anything that we've covered here, then please reach out to your financial planner. We'll see you next time.